All right, everybody, let's see what we got here. Couple minutes to the close. And there we go. Ooh, right at the last second. 29.82 is our official close. 29.82, not bad. A lot better than I thought we'd do this week, I'll say that. 29.82, is that our highest close? Like, in years? Let's get in here. I'm pretty sure that's our highest close. That's got to be like our highest close since like 2022. Let's get some of these off here. Let's clean this up. Let's get my drawings out here. Okay. Clean this up a little bit. Yeah, there we go. Yeah, let's back this up. Let's see. Let's go back 5 years. Yeah. Let's see. Our close, this was definitely the highest close, yep, since way back there, way back over here. What is this? July, yeah, July of 2022. Would you all believe that? So that is definitely a cool way to end the week. Very happy to see that, right? A nice supplies. Hello, everybody. Hello, chat. Cheers to the weekend. I have a Budweiser, but this is the one from Budvar in the Czech Republic, in Czechia, we're now calling it. Yeah, the land of the Czechs. Yeah, so it definitely tastes better, right? Budějovice, I should say, is the Czech name for it now. Yeah, Budvar. So very good. Yeah, pre-open. I don't want to get the opener out. Whatever. Y'all know what's up. But cheers everybody to the weekend. Tasty. Okay. So yeah, so we're gonna spend a little time. Welcome back, everybody, to another live stream, our second weekly market close live stream on GameStop. Yeah, pretty good week. Some exciting things showing up, maybe some topics to revisit in terms of, what was really driving some of our price action this week. Definitely what was driving some of our price action today. There was something a little interesting. We're going to start with reflecting maybe a bit on today's price action. And then, we'll get into some other topics. I want to reflect on some trades that went over pretty well this week. Maybe it's something that, certainly not trade advice, certainly not financial advice, not exhorting you to trade GameStop, not exhorting you to invest in GameStop. Of course, all this content is for educational and entertainment purposes only. But certainly I would appreciate the space to, reflect on some of these trades, and some things have been going pretty well. And maybe, how you can apply some of this to your own life for educational and entertainment purposes. And then we'll spend some time. Last, I want to make sure we take some time to get over to otherwise categories, Big DD as it's called, right? His research there. So we'll check out some of that. So let's see. Ken's enjoying some Baileys. Yeah, what are y'all enjoying as far as drinks today? Give me a shout out in the chat what y'all are drinking while I hop on over to our daily chart. Yeah, here we go. Yeah. Oh, yeah, big IV dip there right at the end. Yeah, so let's pick up right where we left off. Yeah, I thought about that, Rehards. I thought about that too. I was like, man, do I hop in here with some shares? Do I do this? That's not what I opted to do today. I did opt to do I thought we were probably going to come back down pretty low. I was like, well, do I want to leverage? Like, how would that be? What would my delta have been? I try to think about this, right? I try to think about this in terms of delta. I try to think about, like, okay, if I went in, like, obviously you're getting 1 point of delta per per dollar, or not per dollar, per share, right? So the price of the per delta price of a share is whatever the share price is. So at 27.94, not bad. I don't know, right? To get 1,000 points of delta, you're dropping what? Like, you're dropping almost 28K. Yeah, and then you're looking at, okay, if we go up $2, then you can walk away with 2K there on that trade. Not bad. I mean, not a bad rate if you thought you could get something like that out of it. But I guess too, yeah, not sure. Pretty low chance it was going to go south. I don't know. Could we trade that early? Yeah, I don't even think. I think what pre-market, certainly for me, I think I can only start trading at like, what would this be, at like 8 a.m. So I don't think I could have even gotten that price. The earliest I could have entered would have been on this candle here. And look, you notice a lot of people did actually, right? So we did have, as soon as the US pre-market like opened, brokerages that allow pre-market trading. Yeah, we got a good order. We got 3,000 shares came in. We traded right up to the 50-minute, and then yeah, instantly got bought up like 20 cents. So, and then just kind of drifted up there. I chose instead to enter some cash secured puts for January. So that's something I did right like around here. This is my entry spot. And then I actually exited earlier. I could have had a little bit more value out of that, but I exited right when we got up into like popped above 30. I was like, that's good for me. That's good for me today. That was good. Yeah. So in reflecting on this week, right, certainly, I don't know how often you guys trade. Like, I don't know what sort of stuff you guys do, but I've spent a lot of months now that right, the past 7 months, I've switched over to this being the sole means by which I support myself. So I don't have other means by which I generate income. I generate it solely off of trade and investment income. I really like, but there are a tremendous amount of advantages, right? I tried early on in my trading approaches, like when I first got introduced to this, when I first got all excited with what was going on with GameStop and the meme stocks and stuff like that. And oh my gosh, long options, aren't they so cool? Right. And I got bit pretty hard, back in 2021, not knowing literally at all what I was doing, or like thinking about what I was doing very much. It's so easy. It's so easy to lose with long options. If you're trading a long put, you're trading a long call, it's structured against you. It is structured against the buying party. They are structured in favor of the dealers. Of course, I write this in all of my posts, right? So the reason why that is unlike, say, shares, right? Shares it's pretty even, right, between the buying and the selling party. Like, you're holding it, somebody's going to buy it back from you, right? It's both parties, unless you're short selling, right? The long party in holding shares is advantaged because they have unlimited time. Like, it costs you nothing to hold a share, just opportunity cost, right? But it costs you nothing to hold a share. You're not like taxed on holding a share. That's different. That's the opposite of how a short sale works, right? The reason long is called a long is because you're going to hold it long. You can hold it long. There's no penalty for holding it long, something like that. As opposed to a short, where if you short a share, you must pay a fee for as long as you hold the share. So the idea is, like, you're going to want to sell something short for a short period of time. You're not going to want to be out that share for a long period of time because it costs you more money the longer you are short the share. So even though long is used with respect to options, really the time works against you in the opposite way that it does if you're holding the underlying. So if you are short a call, time works in your favor. If you are short a put, time works in your favor. If you are long a call or long a put, time is always working against you. Time is always working against you. So on top of this too, there are all kinds of factors, right? As we've talked about, right? Who says this now? As Ken says, right? The house always wins. Yeah, like we see, like we see with this stuff. Why was I so confident? Why was I like, oh man, like, early in the week, we're definitely closing below 30, right? You guys hear me talk about this all the time in my videos. Why was I so confident that was going to happen? Well, yet again, we have another week of unexpected bullishness. Actually, this was really cool here. Actually, this rebound where we kind of sold off, and then actually right here, yeah. This right here was very interesting to me. This move, because what I think somebody was like trying to screw with the market maker plan to sort of push us back, toward max pain. Because we closed a lot higher, right, than I thought we would have. I thought we would have closed much closer to max pain, down by 28. I thought we probably would have started to retrace back here around 30, like go up, play with the call wall a little bit, and then kind of move back down like that. But interestingly, this move here was interesting, this reversal. And I'll tell you why. So, like I said, I like to trade a lot of covered calls. Right, I don't do things naked. I don't really do multi-leg options. Everything I do is a perfect hedge. So I perfect hedge cash secured puts and perfect hedge covered calls. So why do I trade these instruments? Because they are always working in favor of me with respect to time. So if I typically, when I want to go, like if I'm doing something short term, sort of my bread and butter, day to day, week to week thing is going to be short options, because time works in my favor. And with access to things like gamma exposure, I can see an open interest data, right? And knowing what we know about market makers essentially conspiring to make sure that the stock always closes as close to max pain as possible, that we have very large gamma positions expiring worthless, or large call positions, large put positions expiring worthless on a regular basis with a far greater frequency than would be suggested otherwise, especially on a stock like GameStop. Right, so there's a sort of double advantage. I would say that of my cash secured put trades and covered call trades that I've executed since basically since June, so let's say like the last 6 months, personally, I mean, I don't know how much of this is luck, right? I don't know how much of this is luck and how much this is designed or built into the way these work based on the way that the market makers actually run this. But I track all my trades. I've had higher than a 95% win rate on these trades. And that's with doing stuff that's like not that far out of the money, right? I'll usually target like wherever the call wall is and then kind of go at the call wall or just a little bit above the call wall. And why that seems to work out is that the call wall, right, at least trading on SPY, which is where 80% of all the volume is anyway. Spot Gamma measured this, right? Spot Gamma found that on 88% of all trading days, trading does not exceed the call wall. Okay, no, sorry, yes, right. On 88% of all trading days, trading does not exceed the call wall. So it's not perfect, but if you are, if you're aiming at the call wall for like a short options trade, pretty high, pretty good win rate, right? If you can time the entry like that, right? And that's on SPY, right? So that doesn't necessarily mean that's like that on other stocks. But I've probably seen something similar here with GameStop. And two, what market makers do is we see stuff like this. As they get close to weekly closes above the call wall, like with 25, right? How many times here did we see, right, like closes even here, like even going back to July, right? Weekly close sub 25. We had this run to 29.99, and then still, I think it peaked on like Wednesday, and still that week we closed below 25. So we had a call wall at 25 for, gosh, we had a call wall at 25 from, what would this be? Mid-July, from basically July OPEX to Do we have it at 30 for November OPEX? We did. Okay, it moved up to 30 at November OPEX. So one of the early expiries for early November, probably somewhere in here it moved up. Yeah, we had a call wall breach at 25, whatever this was, like November 11th or something like that. So basically from mid-July to November 11th, if you traded a covered call at any point from November OPEX, if you traded a covered call at the call wall from July all the way into November, that was a profitable trade. That was a win. You could have done it every single week in there. And I probably came close to that. Although in here, I stopped doing weeklies because IV came down so low, I had to move out to monthlies. And then when stuff got so low in this range bound area, right, because IV absolutely flatlined, it was very low. Like I knew something was probably going to come up, right? I was planning on this catalyst showing up, the cat day catalyst that Roaring Kitty tipped us off to. That I was going to have to sell in order to have anything like kind of be worth profit and not, I don't know, basically like have my entire share position as collateral for like $200, was going to have to, push out into something like early November. And I was like, I don't want to be caught in that. So I started, that's when I was like, probably time to go long. So that's the only time, that's when I kind of pivoted, didn't sell covered calls, and then got a big, at the time, at the money, slightly in the money call position at that point. But right, so yeah, so when I learned that from Spot Gamma, I was like, that's a weirdly high number of days that don't trade above a call wall. So if you know where, and right, that's like trade above the call wall. That doesn't mean weekly closes, right? So you'll have a number of weekly closes, like you'll get close and you'll be like, okay, like maybe we're going to start moving up the call wall. And then once you get a call wall breach and hold for a longer period of time, we've been super, super picky about hanging around 30 here. It's been really resistant. You'll see this, right? We'll kind of go in, go out, go in, go out, and then eventually it'll be like, okay. And so then like you can kind of move it up. So like earlier this week, I was doing like $35 covered calls, kind of play it safe, right? The IV was high enough that it made it worth it. And then I kind of came down later in the week to 31. And, knowing that 30 was there, but like, maybe we end up a little bit in the money. I don't know. The 31s were pretty appealing there. Now, of course, you want to be careful with this because you don't want to get caught in a pump. But the advantage of selling covered calls, especially at a strike that's like above a call or significantly above where it is, it's like, okay, you get assigned, you make a profit, right? There's a chance that immediately after you get assigned, the price is going to come back down, and you can just re-enter for a lower price, and then you will have gotten money for finishing right in the getting paid for shares that are higher than your average cost of entry. And certainly the longer the amount of time that you can sell those calls, the more sort of cash that you will pull forward into the present from future potential gains that are not actualized, right? So you're making money basically off of the arbitrage, the like swinging back and forth of the price without actually having to sell your shares essentially by doing that. So something like that. So what was really interesting here, so the reason I brought this up is, let's go back to our 1 minute chart here, was this. So I was after I exited my cash secured puts, so right, if we're looking like okay, I saw we're touching the bottom of this regression channel here. That's also the support line. That's also our weekly 200 week moving average, which we've been using as a support. Lot of this is why I wrote like in the article for today, in the write-up for today, okay, this is going to be like, we've got a test here. If it holds, reversal, right? And maybe we get some more momentum that carries us, into positive territory next week, right? We kind of had more of this reversal now than I thought we might get versus Monday, but okay, so good place to enter a bullish bet, but don't necessarily know, right? You don't want to have time working against you. You don't necessarily want to have, too much capital, maybe locked up in some long options. You don't know what IV is going to be like here. IV ends up working against you late in the day, so it's tricky to time that. But of course, if you enter when IV is high, right? So IV is working for you when you're in a cash secured put. Time is working for you when you're in a cash secured put. All these things are working for you rather than against you. So I should say IV loss, right? Right, basically all throughout here, this entire way up, the $31 calls, we can even bring this up. The $31 calls stayed at like 12 cents. Like they didn't move at all. Even when we were like at $30.30, like this first 30.37, right? In fact, we'll put this in the chart here. Look at this. Look at this, you guys. It just chilled, right? It just chilled at like it went up a little bit, went up a little bit. I guess it went up a little bit here, right? What's that? Couple sales, but it just kind of like chilled right here for the most part between like 12, 13, 14, 12, 13, 14, right? And then it just hung out, right? So it hung out at that. But on this little wiggle that happened, all of a sudden, for some reason, it just spiked, right? So the first time the price went up to $30.37, and the $31 calls were only like 13 or 14 cents. So they barely increased from where they opened, which was around like 10 or 12 cents. Barely. And then all of a sudden, when we reversed and we went from what? They got as low as 6 cents, and then they pumped all the way to 33 cents on this tiny move where we went to 30.50. So in part, actually, that's not what I want. In part, I thought, okay, well, maybe somebody there, maybe this is some shenanigans. Let's do the 1 minute. Maybe this is shenanigans from, a market maker or something, or a hedge fund that sort of knows how to exploit these dynamics and did this on possible. But what I think is somebody here kind of screwed with the anticipated decay arc we were going at, because like everything else, like Chewy pumped today. The number of other things were just kind of getting supported by what I assume was kind of flows maybe back into ETFs after this big sell-off from the Fed meeting on Wednesday, which kind of, rising tide lifts all ships or something like that, whatever. But yeah, there was just such, on this little price movement, there was such a remarkable appreciation in these out of the money options contracts, these 0 DT out of the money options contracts, that I just couldn't explain, other than that whoever the market maker was, the broker dealer, whoever specifically sets the IV value on these contracts, whoever the writing party is here, was fine, basically kind of with this steady IV, wasn't really repricing the contracts too much, these slightly out of the money contracts too much on this move up to 30.37, because this was anticipated. Like they're like, okay, this is buying from this, it's slow, it's gradual, whatever. But whatever happened here was somebody kind of coming in and like jacking the price up real quick, maybe with an options order, something like that. We don't really have any interesting volume. Let me see if I can get MACD out of the way here. Yeah, well, I guess we don't have very much interesting volume for the day, but what here? Yeah, not crazy stuff, right? Not crazy. I mean, it did go up versus like 7,000, but 60,000, not crazy. We went right back. We touched the resistance line on our sort of range bound regression channel here, and then we finally, petered out. But later in the day, yes, huge, like big peak. I don't know what's going on there. Like 5 million, like on close volume. That's in a single candle. That's pretty weird. Don't see that very frequently. So I don't know what that was, but now, yeah, there was. I thought that would be a much tighter close. So somebody might have been screwing with this. Is my point. Somebody might have been screwing with this. That was a weird thing to see happen, right? To see just like that out of the money options contract on this little move, gain 500%, and then head to the dust there. But definitely a very interesting week. Yeah, let's get over to, let's see, what did I say? Talked about some weekly trades. Yeah, before we move on to talking about otherwise as DD. Oh, did cost pump too? That's right. It did go up quite a bit. We got some good questions. Yeah, I want to see if we have some questions on this before we move over to talking about otherwise as DD, who is in the chat, by the way. Hello, otherwise. Thank you for joining us. Welcome to be here. Great work there, man. Let's see. After hours volume. Yeah. So Disco Maloney asks, how much would you have made this week if you sold one covered call at $35, at the $35 strike? Let's go take a look. So if you did it, let's say you did it on Monday, which I think I did. No, I didn't enter on Monday. I entered 35. I did some 35 calls on the top of, because you want to time them up to when you get these big IV spikes too. I mean, it would have worked. You still would have made money. It would have been a winning trade, but you would have had to sit through some IV spike on that. But let's take the 35s, right? So if you have your broker, you can go in, you can check. And, this is a good idea. If before trading these, it's a good idea to just go like, this is what I did a lot of this summer, like when stuff was going on, because I was trying to figure out some of these weird options trades like that I saw come across, like unusual whales option sales. I'm like, why are people making these trades? How is this going to work? And then I would just like look at how the price unfolded historically on this options contract, and then try to say like, okay, how would I trade this to make money on it? Why would I trade this? Why, and yeah, it gave some pretty interesting insights. So let's take the 35. Let's go up here. And let's take a look at what we saw for the whole week. So just 5 days, if you just did weeklies today. So if you did it at the start of the week, if you sold 35s on Monday, if you sold it Monday at open, they were pretty low at open. So you would, and just held it to the close, you would have made $15 if you sold one. However, if you waited until, we spiked up to the top of our, toward the top of our channel, which is right, you want to time entries. Ideally, you want to time entries for when IV is high, the price is moving up, but you think it's about to reverse to the downside. Timing that is good. If you sold them at the top, in here, let's say for an average price of like $1, and you sold one here when the price was in the 31s, 31.50, 31.70. If you sold just one, you'd bring home $100 just for a week, right? And that might not sound like a lot. But if you do that a number of weeks in a row, I don't know, let's say you can make, I don't know, $100 a week selling covered calls, right? You do that for 20 weeks, and just on that, you can afford another 100 shares, and then you can sell 2 covered calls, and then you're making double. And then in 10 weeks, you can buy another 100 shares, and then you're selling 3 covered calls, and then another. Then 7 weeks, then you can buy another 100 shares, and then you're selling 4. And then so you can keep doing this, no matter how small you start. It's, it's slow to get off the ground. But then as you start to pile this up, and depending on how much cash you can stack up, right, you can kind of get it going. You can wheel, as it's called, cash secured puts and covered calls. So you're constantly using probability advantaged instruments. That's what you want to aim for. You want to, like, whatever strategy you want to use, whatever way, if you're trying to trade, you want to trade, make sure you're trading in probability advantaged instruments. That's number one. Or if you're combining, right, so advanced traders will combine multiple instruments of different characters in order to create a probability advantage for themselves. But if you're starting simple, then going short hedged, right, perfect hedged contracts, like especially like out of the money trades, high probability, probably higher than the theoretical probability, is probability advantaged. So that's what you would have made if you sold one. So if you got 100 shares in your account, then could have made $100 on that this week. Cheap, kind of set it and forget it. Like if you really wanted to play it risky, right, you could have sold a 30 in there, which market makers did in droves. And a 30, you probably would have made like $300 if you did a 30. Let's take a look. Yep, if you sold that at the top this week, you would have made $270 by selling one, a 30. And that ended, right, because that's ended the day at 1 cent. So that will end up worthless, right? Now you understand how market makers make so much money from selling this stuff, right? Because they will sell 20,000 of these. You know, I think at one point we were up to like 28,000 were traded. And of course, then they're also making money off of arbitrage between these, right? So they're, you know, traders are flipping these back and forth. They're flipping them back and forth. They're adjusting the bid all the time. They're adjusting the prices as IV moves. So yeah, but good question there. Let's take a look. Rolando here says, this is the accumulation distribution indicator. I saw something like this on Superstonk today. I don't really look at that. I don't trade on that. So I don't know what's very typical of it, right? So I have a certain number of indicators that I do look at regularly because I do find they offer me some predictive advantage. There's all kinds of indicators, right? There's more indicators than you could possibly want to use. It might not be normal, but I'm unfortunately not the right person to ask about that. But definitely a good question. Merrick, real quick, what website software do you use for the GEX exposure by strike table with percentages? So that I get on Unusual Whales. Unusual Whales calculates that data for me. You can crunch it yourself if you want from the OCC dashboard. But yeah, and then I modify that too. So like I'm the one that draws boxes and stuff around it when I analyze it myself. But yeah, I mean, if you want, we can take a little look at that. Can I log in there? Let's go. I'll show y'all what it looks like. If you're interested. Here we go. No, not this one. Why can I not find this tab? Whatever, we're just going to do the window. Okay, can y'all see this? Does this show up for you guys? Yes, yes, yes. Yes, good. So, yeah, so if you want to look into Unusual Whales, I think you can get this with their premium package, something like that. So it looks like this, right, when you log in. So there's like a whole thing where you can check out different metrics for options Greeks. You can see them represented, right? Traders use different things. You can visualize the charm. You can visualize the Vanna. I don't trade with this yet. It would be a cool thing to incorporate into my repertoire. They don't have a lot of tools for charm and Vanna, so I just kind of think about them vaguely as a concept in the background. Gamma is what I use, of course, as you guys see when I write up my analytics. That's what I use the most, since that is my best rule of thumb for estimating market maker hedging properties around certain price levels. And you can get it like this. So when I look at it, right, I get this whole table that then, right, I draw my boxes around here, and it tells you to what degree. So these percentages, by the way, will tell you what percentage of all of the normalized GEX is, that means gamma exposure, is concentrated at that strike. So for example, when you see $25, 3.63%, it means 3.63% of all of the total net call gamma is concentrated at that strike. I mean, you can sort of get a sense relatively. It's good to look at the absolute values too, and the net values. Oh, a lot of them came off the board today. How about that? Oh, no, that's up there. Right, so like obviously you can pick out something like a call wall if you see like a huge percentage there across all of our dates, or then you know some people like the bar chart. Sometimes you'll see me post these bar charts for the individual weeks. It's pretty obvious, right? Like when you look at a chart like that, you're like, oh yeah, the price is not going to finish above that. probably. It's going to be here. And especially too, like where you see these strikes where there's just no put OI or there's like no call OI or something. It's like, oh yeah, like if suddenly things become bearish, it's not going to close below here, which is 25. It's not going to go here because of all this gamma here that functions as like a wall. It's not going to go down there, right? Here is our high probability range. And that's not crazy helpful, right? 30 to 25. It's okay for selling covered calls or cash secured puts. You can navigate. That's super helpful for that. And that's the other thing too. If you're trading a long call or a long put, like you need to be crazy precise with your timing and when you entry and when you exit and stuff like that. The other thing about trading a cash secured put or a covered call is like you don't need to be that precise. So like some people I remember on Super Strong, like 99% of people who commented on my stuff were the best. Like everybody who commented on my stuff was so nice over on Super Strong. But there'd be like that one troll who'd show up and be like, you know what you're talking about, right? These guys would make a scene in the comments. I don't know, they didn't like that they weren't being paid attention to or something. And they say like, oh, this isn't helpful. Like you don't give specific, like you predict whatever. It was like, my brother in Christ, how precise do you want this to be? You don't need it to be that precise in order to make money, right? If you can narrow this down to like 2 scenarios and you can be like, well, it's going to go to like around 28. And if it does, it's going to go to like around 30. And then it's not going to close above there. It's like, there's a lot of trades you can do with that kind of information, you don't necessarily need to be like at 11:52 a.m. The price will be 28.63 and then it will go right at that point up to, you don't need to be that precise. It's too difficult to be that. You can't be that precise unless you're cheating, something like that. But you can, I've been able to get more precise over time as I've worked with the data, and I've been able to incorporate. This is actually where the technicals kind of come in because they allow you to be more precise by giving you insight into the picture from a different angle, right? So you can be more precise because then you're approaching it from two basically like kind of mutually exclusive ways of visualizing the data. Thinking about it, like I've used this analogy before, right? It's like, approaching it with sight and hearing, right? Or taste and smell. Maybe not taste and smell, but like sight and taste or something like that, right? They're pretty, like your senses are pretty exclusive. They're not that similar to each other. And so if you can use all of your senses in order to perceive the same thing, like you get a 5-dimensional picture of what the thing is, right? You want to layer emotions on top of that, you can add extra dimensions, something. But so if you can approach this stuff with gamma data, and you can look at the OI, and you can look at historical price level, like support levels, and you can look at technicals, and you can do studies and drawings on them, and figure out these different shit. Like you can get a lot of data from different angles that allows you to get that precision down without compromising accuracy. So yeah, this is what it looks like on Unusual Whales. So I think their monthly thing now, if they might still be doing a Christmas special, is like $40 or $45 a month. So not crazy. You can do a yearly subscription if you're really going to use it. Obviously, I use it every day, quite a lot. So it's definitely well worth the expense. To me, this is not how I was introduced to this data. I think I've mentioned this before. I was introduced to this through Spot Gamma. Spot Gamma is where I learned how to read some of this data, but Unusual Whales offered me access to the data for like a fifth of the price. So that's why I subscribe. I continue to subscribe to Unusual Whales, but not Spot Gamma. If you're like a crazy pro like index trader, then Spot Gamma does have some other really advanced tools, as well as their kind of equity hub thing that'll give you this data, and they visualize it in some cool ways. They have cool write-ups and stuff. So, but it's a lot more expensive. Ooh, that's cool. Tom, where'd you see that? 1.1 million shares? Did you see that in like did that go to like a dark pool or something? Where'd you see that, dude? Yeah. Okay. Well, he's going to get on that for us. Let's go over now. I think this is a good transition point. We'll have some more time for questions on the end, but I want to make sure that we get to talking a bit about otherwise his DD, his big DD, as it's called here. This is certainly very interesting, certainly very useful well, for a number of reasons. One of the reasons I like to read this stuff, right, why I like to look at, or well, number one, effort was put into this, right? This isn't, a menagerie of hype balloons or something. Like it's very useful, even if it's the same information. Like otherwise, man, you put a lot of work into this. It's very clear you spent a lot of time on this. It's well researched. Like you went and you read things that are worth reading, right? You went and you read sources of information on this stuff. This is very useful. It's very useful to say insofar as it points people to go take a look at your sources and examine this stuff as well, right? This is not like just like some Reddit post where like somebody heard someone in a different Reddit post talk about something, and so they copied that Reddit post stuff, like, right? That's of a more dubious quality versus going and reading like, the SEC official report on what happened with GameStop in 2021. Okay, that is not a dubious source, although we can still be critical of it. Right, so very useful insofar as there's this stuff presented, very useful insofar as it's presented in a very readable and engaging way. Otherwise, has really done a lot of great work here to array this in an understandable way. And yes, okay, right, he's also posted about some of the stuff that he put in this big DD in some of his other posts. Some other people have talked about some of the things that he's talked about. I saw a number of people on Superstonk. I don't even know if they're real people say, oh, there's nothing new here, blah, 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 blah. That's always one of the worst like complaints that ever I heard. I hear people say that too when I spent all this time in academia. That was one of the worst criticisms. Well, there's not really, anything new here, whatnot. It's like, well, presenting the same information from a different angle, but coming to the same conclusion by a different method, even though you arrive at the same conclusion, that's useful, right? You took a different way to arrive at the same conclusion. That's useful. This is actually one of the problems we have with academic research nowadays. In science, we have this great replication crisis. People are unwilling to do the same thing that earlier people did because, like, they think that doing something new means you come up with an original thing and you arrive at an original conclusion and every single part of it's original and it all just works out. Well, that usually doesn't happen. And what's more useful for scientific research than, well, this one person did this one thing and got this one result. That's not super useful. That's an anecdote. That's the equivalent of a scientific anecdote. But if you say, well, these three people did this one thing and they came to these conclusions, and so I did this a fourth time, but I modified this variable and I did it this slightly different way and I arrived at the same conclusion, that's more useful because that validates, that strengthens the findings of these other three people. So that's tremendously useful. So I want to make sure I got that out of the way. Yeah, I mean, right, I see NB here, people saying, right, people are salted that he dislikes RC. Hey, we're allowed to have our own independent opinions about these guys. Nobody says you have to like the guy, but I like what he's doing with the company. I'm not as right. I guess maybe this is heresy or something like that. Certainly to people on MOAS, but for people who are betting on this kind of MOAS thing where it breaks the market, right? Because there are a lot of people, probably I don't know how many people, but it seems like there's a sentiment there. And I wonder how much of this is manufactured. There's a sentiment there of some people who they're like, no sell, and they're like serious about that. Like, I won't sell until the company is worth a billion dollars per share or something. Like, if that, like, realistically, if that were to happen, it's like the entire global economic system would collapse. The entire global economic system, like, would collapse if GameStop went to like $50,000 a share overnight. Maybe in 30 years, I don't know, like if it turns into, or 50 years, if it turns into Berkshire Hathaway or something. But if it went to 62, like what is 69,400 or 42,690, whatever it is, whatever those numbers are, like the entire geopolitical system would collapse. That would be terrible. Like everyone would say, almost everyone would be okay with the government colluding with financial institutions to prevent that from happening, because a world with some financial corruption is better than a complete collapse of the global security and economic order. Like it would mean pandemonium, right? Everybody would go into, it'd be worse than a world war. It just war everywhere for however long it would take for a new global hegemon to sort of fight it. It would not be good, right? And that's why it was tolerated. That's why this collusion between, say, these lending institutions and brokerages and the government looked the other way, both in 2008 and when they shut off the buy button in 2021. Why that was tolerated is because nobody wanted to watch the entire global economic system that's been in place since the end of the Second World War, which has prevented the emergence of a hot war like the Second World War or like the First World War, which are two of the worst man-made event, like human, anthropogenic cataclysms in history are the world wars. Like stopping that from happening is a really good idea, like. In any case, I digress. The historian in me wants to press on, but let's talk a bit. I'll point some things out here about the big DD here. What Otherwise has put together for us. He does a good job here outlining basically what his claim of this article is. It is basically that there's a missing component, by and large, there's a missing component from the SEC report on what actually occurred in 2021. And his argument is an argument others have made, though less specifically, less in detail, less precisely, I should say, that a lot of the upward volatility, not only in 2021, but also in future runs, was caused by an overlap at times of a settlement window, what he has called a boofing settlement window, and which is his term for ETF-related fails to deliver settlements. And the second one, which is regulation extension code 068. So this is a margin call extension window. And he's basically derived these two basic formulas in their former state and in their present state, and used them to try to see if these formulas can predict when a major sort of like one of these externalities that I'll mention, one of these things that kind of emerges, causes big upward volatility, and breaks the closed, technically bound trading system that we're normally working in. Whether with this formula you can predict something like that. So, so the basics, right? There's this settlement rules for FTDs. We have this T plus 35 thing. Some of you have perhaps heard of T plus 35. I know Richard definitely has talked about this. What seemed to me, right? This came to my attention this past summer. So the rule here is, right, whenever you have a fail to deliver, a market participant has up to 35 days to deliver the security which has been failed to deliver. So if a market participant, a broker dealer or somebody goes and purchases something, or they have a short share that then they have to return, something like that, they can sort of fail to deliver on it. They can say, oh, we haven't bought it back yet, but we will. We don't want to do it now. We'll do it later, right? So they're given an extension window, and they're essentially given an extension window of up to 35 days. What Otherwise has done here is break this down in terms of saying, well, it's not exactly 35 days. It's the standard settlement period. So it used to be T+2. As of this June, it's T+1. So it's T+2 or T+1, followed by the 35 calendar day extension, essentially minus a day, and then a T+1 on the other side, something like that. So the minus one has to do with, right, so the fails to deliver must be closed by market open of the 35th day. So the minus1 comes into, well, it means that prior to that 35th day is when they're going to buy back their shares, if they've failed to deliver. Another type of settlement issue comes with margin calls. So many people might think, well, okay, margin call, they come in, they get notified, and then you have to meet margin requirements that day. Well, that may be true for you and me because we are retail buyers, right? Our brokers, of course, when we get margin called, I remember I was margin called back in 2021. I think like the 22nd, right when we started to move up. Because GameStop, you could no longer trade GameStop on margin. And I had some other positions. I was, whatever. I was just buying random stuff that was going up and it was working. So I kept buying stuff, and GameStop was one of the positions I had opened back in January of 2021. And there was a margin call suddenly on my account because I was trading, on like 50% margin. And suddenly it said like, nope, GameStop, you're not allowed to have any margin at all. So you have to double the amount of capital that you have in your account immediately, or we will sell all of your GameStop now, is what came through. You have 24 hours, or we will forcibly liquidate your account, right? So you and me, we get 24 hours. But major participants, market makers, institutions, they do not. They get a T+15 day allowance in order to meet their margin requirements. And if for some reason they need an extension, they can file a Rex code 068, which is a regulation extension, where they can get up to 14 calendar days from on top of their normal window. And there are also FINRA holidays. FINRA holiday exemptions that can be built into these as well. So, right. So what was really interesting was, and I really encourage you to do this. I encourage you to take a look if you're interested in seeing how all this plays out. Otherwise, does a really good job of right laying this out per chart, right? Okay, here are the dates. Here's what this would move forward to. Let's consider, for example, this particular days of the, let's consider the days of the sneeze. Do these line up with these particular extension cycles, something like that? And walks through these. And he goes in particular through each of these particular sections, goes through how Rec 68 works, goes through what he calls boofing. So this is the internalizing of a trade by strategically failing to deliver within an ETF, right? So you don't want to just fail to deliver constantly on a particular ticker, because then that ticker, like what happened in the fall and winter of 2020 into 2021, is if it could go on regulation show, which I think stands for short. They're very unclear. It's not an abbreviation. I think it just stands for short. So there's extended short sale regulation, and there can be forced buy to closes that happen if you do that. So what market makers do, in order to manage settlement, things like this, broker dealers, they will use creation and redemption orders through ETFs so that they can fail to deliver securities in an ETF where you are allowed to make infinite shares. You can fail to deliver over there where ETFs can't go on Reg Show, whereas with a individual stock, that's the case. So what he proposes, and I would have to basically go through this with something like a fine-tooth comb here to see if it does line up, is, I mean, he does a very good job laying this out, right? And when I say go through this with a fine-tooth comb, I mean, something like double check to see if I can do this as a forward predicting method. right? He goes through this. He talks about how GME in particular, in say the events of 2024, in mid 2024, back what happened in May, June, was probably going to have something like an event that we saw in January of 2021, that this was perhaps a stage of the Requel that Roaring Kitty had set up, and that it might have happened, right? It looks like it might have happened were it the case that the 110 million shares of dilution did not occur, which allowed all of these sort of delayed internalized orders to sort of fizzle out, right? The pressure that was built up from these internalizations, from all of this unexpected volume, was allowed to, it gave it an escape valve through the new shares that were created in the company itself. So they didn't have to play out along these timelines. There didn't have to be this, a lot of this margin call buying. And yeah, more or less, I was very interested in this because when I was looking back, I think one of the first things that encouraged me to write about the options dimension of this. Now, I'll take us back over to our chart for a second here. Was actually this T35 thesis that that Otherwise writes about, that who's the other user, another user who's disappeared from Reddit and disappeared from Superstonk was Lenarius, although I think he did this as a ban bet, which is unfortunate because then you rob yourself, you rob the community of your insight. It's okay to just be wrong. Like, you can just say, I didn't get this one, guys. I was wrong. I'll do better next time, right? And you just keep getting better. But if you ban bet, as soon as you're wrong, you don't allow yourself to get better, and you can't continue to serve the community that way. Let's see. Here we go. So this was interesting to me because I started publishing my stuff on Superstonk. Like, I wanted to publish it earlier. I actually wanted to start doing this in May, like right when Roaring Kitty came back, and I tried to publish something. Actually, it was when he revealed his options position was the thing. Because I instantly was like, oh my gosh, they didn't hedge his options position. They have to hedge the position. It means that if the price goes over $20 again, it can't go below $20. Like, that's incredible. It can't go below $20 while he has that positioned out, because they have to hedge all those contracts. They have to hold all these shares. There's no way it can go below that. That effectively functions as like an impenetrable call wall to the downside of our price action, which, I mean, we slightly dipped below that a few times down the road, but like, that established this very long-lasting floor. Like, having those calls, like, they still, people to a certain extent, I think, are upset. I understand that didn't play out perhaps the way it wanted to, but or maybe Roaring Kitty, or maybe some of them who wanted to exit for a higher price than what we saw on this kind of double peak here may have wanted. The fact that he held those calls kind of through that, and this is to Keith's credit, right? The fact he held that through that really made sure that no matter what happened in here, while he held those calls, and while everybody knew he held those calls, while institutions knew that he held those calls, that the price wasn't going to go below $20. That was going to be a floor because of the hedging requirements. And by exposing Wolverine Trading like that, from not having hedged his order, it meant that other institutions recognized that and would dogpile the price to basically force Wolverine. See, this is what I was interesting to me that Otherwise was writing about this, is by revealing that position, he made other institutions would have become aware that Wolverine Trading was not fully hedged properly on his calls, that they had, as Otherwise says, boofed it, right? That they had internalized these trades, that they had kicked the can down the road. They knew that had happened. And so then they could bump the price up. They could jack the price up and basically put Wolverine Trading in this terrible situation where they were short all these shares, they didn't hedge properly, or they're buying shares that are way more expensive, that, you know, something like that. So I'm sure there was something like a crisis that went on there. But what was interesting to me was this T35 hypothesis. And I sort of became aware of this. Lenarius was writing about this somewhere in here. And so we were waiting on the figuring out. Oh, Biggie also wrote about this. There was another user, Biggie, who mysteriously also disappeared. So like, if guys, like if you're on Superstonk, like people who contribute stuff that's meaningful disappear, right? So when people put together stuff like Otherwise just put out, stuff happens. Like Biggie, something similar to what happened to me and to Otherwise recently also happened to this user named Biggie. Something like that. He also tried to establish a YouTube. I don't know if he's still making it, but he also outlined this, and also outlined this sort of T35, you know, kind of cycle thing. And it would have placed, right, the T plus 35 covering of the exercise, or I guess would have been, so this is another thing that Otherwise is good to point out, right? It seems that Roaring Kitty did not exercise his calls. What he did, because that would have required, you know, that would have required delivery immediately. Buying in the lit market, that's harder to fail to deliver. That what he did is he sold all of his calls and then bought shares. And by doing that, he would have initiated a T plus 35 cycle, right? He would have, you know, that could have been boofed because it was a lit order, and kicked the can all the way down the road to what I think Lenarius pointed out. It was going to be like the 17th. You know, we weren't sure. Do holidays count? Does July 4th count? Like, how does this work? So it was going to be sometime around July 17th, which was, I think, or the 16th, which was one day before July OPEX. And so this was one of those times, actually, I did play this. Many people were disappointed because it didn't go crazy. But I remember entering long calls. Let's see, is this June OPEX here? I remember this is one of those other times that I actually opened up a pretty decent sized long call position. And I opened it up. I think I started to accumulate here and then here. And I remember, like, you can go back. Oh no, I think these posts maybe were deleted. I don't know if I have. No, I think these might be gone. Actually, these are gone forever, unfortunately. But these were some of the first, like this was the first maybe 3 weeks or so that I was posting on Superstonk. And I remember writing about this. And, you know, I was able to write about how we were going to move through. It looked like we were going to move through the $25 call wall, and we did, and sort of, you know, options kind of rode us up. And what was interesting is volume was not particularly high, but we were just kind of marching up. And then as soon as we got to 30, we bounced off 30. 30 had become our kind of new call, and we quickly went back to the downside. So on these moves, this is a Monday, on a Tuesday, this is when we topped, where we topped above 30 in the pre-market, but our intraday high was 29.99, I'm pretty sure. Maybe not quite that high. I guess on the day it was 29.99. But right through here, I also noticed that there were a fair number of puts that were building up underneath this. So somebody knew that the price was going to come back down. So I noticed these things happening in the options market. I saw how this was played, and this actually worked. Like I tried to, I don't know. I had some readers there. I tried to mention some of this, but basically my conclusion at that point was, oh, the T plus 35 thing works. And you know, but again, this goes back to what I said at the beginning of the live stream here. Don't try to be too precise when you're building your trade. Like, okay, if you go out and you say, okay, it's going to be around this date, like, give yourself a broad window. Like, try to capture. Think about the instrument as a way to capture value. Think about the capture of value as bracketing a movement. So you don't have to squeeze every inch out of that line or that arc, right? You just have to, like, pick a number you'd be happy profiting with, and then when you get that, like, you know, when you get the movement unfolding, while you still like have your kind of window of safety there, while your instrument is still not being hammered, or being hammered in the right way if it's short, right? Pick a point that you want to come out. Like if you're up 5K, like, is that good enough for you? Like hop out, like you did it. You predicted the move, like be done, right? That was a huge problem I had early on. I was always trying to squeeze as much as I could out of every single move, and then I miss it, and then I'm like, oh, but I'll hold it and it'll go back, and oh no, it went lower, like, oh, now I should jump out, oh, but now it went back, and you beat yourself up, right? So this was a problem. I felt bad for Lenarius, because Lenarius, unfortunately, this user, like, he got it, right? He got the T+35 thing. He was right. But he thought that on the day of T+35, his T+35, it would have been, so he said, I think the 16th, which would have been Thursday. And by otherwise's thing, right, having, right, sometimes they do it the day before because it's due on the 35th day, something like that, right? This would have been within T+1, right? It happened here, like it peaked, like the guy got it right. He was off by like a day or so, but he got it right, and he had a huge options position. He had a huge naked long call position. It was, in a single leg, and it went, and look, it even lined up with the regression channel here. Like it went slightly above. We got a big oversold signal with RSI. Like, oh no, like I felt so bad for the guy. But of course, I was like, okay, that's it. Oh, $30? Cool. And I sold and got out and saw that we had put gamma accumulating on the downside, because whatever institutional traders were also trading this move also knew that it was a T+35 cover. They also knew this. And so they built puts because they knew there was no reason for it to go past 30 at that point. That was it. That was the end of, this, let's call it catalytic boofing, to use Otherwise's term here, since he's the star of the show today. And so then, we traded all the way back down. Now, I remember writing about this. I thought we might have found some more support at 25. We didn't. We fell right through 25 at the time. So, I tried to trade that a little bit, gave a little bit of my gains back, but, was able to get out there. But man, I felt so bad for Lenarius, but I was also like, oh, the T+35 thing, that's pretty cool. Wonder when we'll get another one of those. And then, Otherwise, I think did another good job of pointing out T+35 from the September 6th tweet. Was it September? Yeah. Right? Did I get that right? Otherwise, is it the September 6th tweet was a T+35 window? No, that seems too far away to be. It would be September 20th, I think, would be the T+35 from, what's it called? For Cat Day. No. The Cat Day thing in 2024. Biggie's DD, I don't know if it's even around, right? Yeah, they were wrong about the formulas, is what I remember Otherwise, right? So Otherwise says here that they wrote about T+35 trading days, but they were way off. Yeah, they were wrong about the formulas. The concept was right, but yeah, because I remember Lenarius somehow got the date right from when Kitty sold his options position and added his shares. That's what I thought this was. Supersound sounds like Moscow. Rehards. Yeah. So in any case, yeah, Otherwise also wrote about this. Wrote about, right, it would be T+35, right? We had this tweet on September 6th. No, I guess it would be, I forget exactly. You have to take a look at Otherwise's DD. But he did raise some interesting points here, insofar as, are these catalysts, do these tweets project something, right? Do these posts project? Can we use this as a predictable heuristic for when we can anticipate something like, is there a big up move that a market maker or an institution, somebody who might get margin called, is going to try to kick down the road? And with, let's see, we had this big day, right? September 20th. Where is September 20th here? Should be, and this is September. It's October. It'd be this. This is the 20th. Right, so like T plus 35 calendar days, where does that get to? That would be roughly like October. Yeah, I guess it would be the 20th event would be around T plus 35 calendar days until the day before Cat Day, something like that. Right, so that's when we've had the beginning of our first up move into Cat Day, so beginning on the 28th. The VW squeeze-iversary. So it's possible that this was something kicked with respect to the September 20th move, and maybe this move up here later was right around November 11th was something, I don't know what that would be related to. Any case, right? It's I won't go on, right? Otherwise, also has 920 to 1028. That's what I was looking at. That's right. Cohen's YOLO tweet. That was it. Yeah. So another good point, right? Otherwise brings up something he's been looking at is like looking at the tweets in particular, the posts in particular, as potential catalysts for forward projecting some of this stuff. So another date I had been looking at, and then this is actually one reason why I was particularly interested and otherwise coming up with this date as well, is it seemed to me like, the part of the Requel, part of the Requel was, yes, stuff that was going on up here, like what Roaring Kitty was trying to do in May, June. But I think he had kind of it seemed me like he had something of a grander plan, like he had this in the short term, but then, anticipated that whatever, let's say it went super high, that it would still come down, but then could set up for something again on some of these rhyming dates. Like he's clearly not just kind of bowed out that this Requel that he's been working on. I mean, maybe it wasn't plan A, maybe it was kind of an improvised plan B, not sure. I mean, a lot of people yeah, I mean, he also knew, right. Noodle says he mentioned the at the market in his memes. Yeah, he also mentioned that in his live streams back in 2020. So like he mentioned that as like a strategy, knowing what Tesla had recently done. So the slow as thing is something that Roaring Kitty definitely knew about. And in the live stream, he also mentioned like 3 to 5 years, right? He also mentioned that after Cohen did the second at the market. I had a similar idea to Otherwise too. Otherwise suggests that Roaring Kitty did not expect the second at the market, perhaps, and that had kind of foiled some of what he wanted to do with the live stream. That's how, like, he still met some of his objectives. There were some of his objectives that he had that he wanted to meet with that live stream, but I think there were some of them that he kind of shelved. That's what it stood out to me, because I kind of walked away from the live stream thinking like, that was kind of anticlimactic. Some cool stuff that was cool to see, but I wonder what's going to happen. I was kind of expecting more. Yeah, 14 grands from the ATM. Yeah, that's right. Well, did they sell 140 million? I don't think they sold 140 million. I think it was 45 and 70 and then 20, wasn't it? 135. Yeah, that's the thing with the memes. It's a little difficult there, but anyway, my point here is that otherwise pointed to potentially a T plus 35 kind of boof settlement thing, reaching a climax sometime around January 10th to January 13th. And what's been interesting to me that I've been, I was pointing to this as saying like, well, if we are doing this kind of beat for beat Requel, the really big exponential kind of groundbreaking thing in the 2021 sneeze was not Cohen's buy-in in December. That did play a role in that trade was kicked down, the can was kicked down the road to a certain extent, which otherwise talks about. But that when Ryan Cohen joined the board, this caused, like this announcement ended up causing some retail, retail dog piled in, something like that. There was a lot of positive sentiment that ended up lining up kind of perfectly with, maybe some sort of margin call or maybe, somebody can kicking something be an ETF order or something like that. And that this ended up, okay, I will, Liberty. This lined up, right? A number of these different factors kind of piled up on top of each other. And that's something that the SEC report mentioned, that which is really too, I think otherwise links this in his DD. It's really worth reading. I think that's where I got the link here. Let me see if I can share this for a second. So it's the staff report on equity and options market structure conditions in early 2021 by the SEC, which was published on October 14th. Some interesting things here, right? They did mention that a lot of this had to do with retail sentiment and with the very large number of new accounts that were opened. Very curiously, there were a very large number of new accounts that were opened, say like something like over half of new accounts that were opened in 2020 during the COVID period by Robinhood were like 19-year-olds. Like the median age was 19. So like there were a lot of new people that came in with some money who had never traded before, who like instantly went over to Wall Street Bets and then were, got exposed to, hey, GameStop. Like I remember in the fall of 2020, like GameStop memes were everywhere on Wall Street Bets. So it was really easy to get interested in that. So there are a lot of new buyers, which meant a lot of new money. Certainly, there was a lot of call buying. So there, although the SEC said, "Oh, it wasn't a gamma squeeze," or there were some things that made it not consummate with a gamma squeeze. There was a lot of call buying basically leading up to around the 22nd of January. So one phase of the squeeze, or I should say the sneeze, was driven, at least in part, by a high volume of retail share buying and retail call buying. That very likely some of these dealers who internalized their orders and didn't want to cover their positions, or shorts who didn't want to cover their positions or something, or internalize them in ETFs or something, in the lead up to the end of 2020, did not anticipate that retail would start to pile into this as early as they did. And they thought, okay, this will die down. We'll just kick the can down the road until after that's done. But that didn't happen. Let's see, let me go back to my chart here. Let's bump this out. 5 years. So So basically, like this portion of it was very controlled. So looking like what we're looking at now over on our 4-hour chart. So this was very controlled. So this was, things going, according to normal. Maybe not what was wanted, but enough internalizing to keep things technically bounded. Okay, we'll keep this in the bounds of this technical paradigm. We'll sell options. We'll make a ton of money, just like they are now, right? We'll make a ton of money off of letting this thing swing back and forth, so we can just let this take as much time as possible, so we can suck money out of the options market. This is something the SEC report leaves out. Okay, the SEC report doesn't talk about short options, and maybe part of the reason why they don't is it's the best kept secret of the current market, is how much money gets sucked out of retail buyers by short options, by dealers being short very large numbers of options. Because if you think about it, right, what it allows you to do is, retail will, many cases, and has historically, right, they'll be really convicted in their stock. They'll be really convicted in, whatever their whatever their particular play is, and they won't sell, just like you see with all these people who are willing to hodl GME forever. And people, there's all this thing of like, oh, you got to watch out because the stock could go to zero. Like, don't hold it to zero. Don't buy in a dead cat bounce and hold and think, oh, it has to come back. It has to come back. Right? All of this traditional like insight about stocks. Like, how many people, like, who holds a stock to zero now? Like, everybody's trading everything all over the place. Like, who really is holding like a coin to zero? Or people jump out a ton. It's so easy to go, and like trades have no commissions now, so there's not like I don't want to sell it because I have to pay a commission. It's commission-free trading. Everybody's hopping in and out all the time. But right, with an options contract, with a short options contract, is you can speed up that phenomenon. So you can make that happen every week. You create, I don't know, 200,000 securities, essentially, right, shares of a security per week that all expire worth nothing. So you make them go to zero every single week. So that, that's basically like over what that ends up being, something like, right, 200,000 per week, and over 50 weeks, let's say. You've got 10 million shares of a particular company where, let's say, the average value, even if you say the average value is $2, that's what, $200. That's $2 billion on a single stocks, right? That's like having a company worth $2 billion become worthless in a year, right? So they do this, but this way they can kind of mulct, I should say. They can mulct value out of this. They can make it take as much time, and then they can make sure they don't get margin call because they just stack up that cash. Okay, we'll jack up the IV, right? Something like that. So that was that kind of first phase, and then they thought they could internalize it basically into January, and then everything would be fine. But then it came time to start to maybe cover Cohen's order or settle Cohen's buys in December, or start to get close to that. But boom, Cohen announced he was going to join the board. Retail got super stoked, started buying calls, started piling more into shares. And then in the first days of the sneeze, as otherwise points out, that's when these windows of margin call windows and boofing settlement windows started to like actually become due, and it was time to pay the piper. But retail settlement, especially in buying shares, did not die down. Now, what was very interesting is that on January 2nd or 22nd, call flows stopped. So retail call flows stopped on January 22nd. This, both the SEC and SPOCAMA interestingly pointed this out. By the 22nd, retail actually started taking profits on their calls because IV was so high, which is something I would not expect from new call buyers. But basically, the options phase of that options phase of the sneeze did not really persist into the 23rd to the 29th kind of period, right? Because the 29th is when we petered out here. What's weird is institutions, so market makers themselves, were buying a ton of very expensive calls from retail that was selling them to them. So in order to have those, so that they could exercise those contracts themselves or use them to meet hedging requirements rather than having to buy these shares at crazy prices. But what was really weird that the SEC report didn't mention, that Spot Gamma pointed out, and I don't know necessarily what the validity of this is, but Spot Gamma pointed out that it looked to them like what really drove from the option side of things was a weird amount of short put volume, like huge increase in institutions selling puts, like in massive, like if you guys can see this chart, right? Call OI, or I should say call volume is in green, put volume's in black. So between the 22nd and the 29th, the highest traded instrument was a put. But what Spot Gamma actually, if you have time to read this too, I'll link this as well, if I can modify the description. There was this phase after the 22nd when calls were being sold to the market makers themselves. So market makers were buying calls. This is what they call the first push. But the super squeeze from the 26th to the 27th, retail buyers, meaning people who were, say, like, so not Wall Street Bets people, not people who had, say, been trading, I don't know, prior to the actual day that the squeeze started, like the 21st or the 22nd or something, like people who created their trading accounts on like the 25th. So like this huge wave of people that got like amped by, Elon Musk and Mark Cuban and like, I don't know, CNN or something being like, look at GameStop, those people came in to buy shares at whatever price. But interestingly, like this is the part that I don't understand yet, that I really have to look into, that is not really fully explained, is how much put volume, short put volume there was, excuse me, from institutional investors. So what it actually looks like, according to what Spot Gamma points out with these put flows, because call OI didn't go up, right? Here, if you look here, right? Call OI throughout this period did not go up, but put OI went crazy. Look at this. Put OI was like 5-1 on that thing when the price was skyrocketing. Actually, this is in early February, but it just ramped up hugely. And what Spot Gamma thinks is that, right, they come right out and say this. Somebody was just they think that somebody was pushing this up because the bulk of these put flows were traders selling puts. They don't really explain why they thought this was, but that's such a weird dynamic, except that the only way this could make sense to me is like traders wanted to specifically push this higher and higher and higher. Maybe institutional traders did this and did so at a less risky, I don't know, they hedged their risk by choosing a short options instrument rather than a long one so that they could benefit from the IV crush on the other side. Yeah, so that was a really interesting dynamic. But anyway, right, to kind of sum this up, Otherwise has done a really good job bringing together a number of these different factors. Has, I think, presented probably clearest expression of a T plus 35 and sort of Rex code 68 overlaps, right? Something that explains why these catalysts have these kind of shadow price actions a month or so down the road, what actually this entails. And that what Roaring Kitty perhaps, or Roaring Kitty in combination with Cohen may be trying to organize in terms of this Requel is generating catalysts to have these overlapping layers of margin call, of FTD settlement, of potentially trying to stimulate the right confluence of these overlapping windows such that, perhaps it'll draw in, I don't know if that's their intention, but that it would draw in that similar type of buying, maybe from retail to a certain extent, or from well, what's interesting, right, is at these final stages, what SpotGamma is suggesting is that it was institutional traders selling massive amounts of puts that blew up the price, while market makers were actively buying calls because they couldn't get shares to hedge their positions. Weird stuff, but in any case. So that's what's up. That's what's up there. I'd just like to say otherwise. Thank you so much again for your hard work. Right. So there is a video out there. It's an hour-long video that otherwise has on his YouTube channel. I'll also link in the description when I finish up when we finish up our stream here. Yeah, take a look at his DD. I mean, we don't know what the state of his profile is right now on Reddit. He was gone, he was back, then he was gone again, and I have no idea. I checked mine. I wanted to check and see if it was like a hiccup or if something similar would happen with mine, but no, my old profile is definitely fully gone, locked out, still deleted, but by Reddit. So definitely go check those out. I would recommend. I'll also link this. Yeah, give a read to the SEC staff report and give a read to what SpotGamma had to say about this back in 2021. It was before the SEC report was released. They've written some other stuff that was interesting about it. They wanted to take advantage of this, and they published articles that said like, "Hey, how to spot a gamma squeeze," and that's how I learned how to spot a gamma squeeze, or potential for one, by the way. So go take a look at that if you want to learn that. Yeah, so that's it for that topic. I'd say let's bring that to a close. Does anyone have any other questions that we didn't get a chance to go over earlier? Maybe at this point, related maybe to some of these topics, or maybe some of our earlier trading topics, just to before we wrap up for today. See if I can scroll back here. Samuel Bowser's got a cool name. We got one from Tom here. Let's see, Tom. If there is a boof 35 happening sometime in January, is there anything market maker or regulators can possibly do to stop or extend it? Yeah, that's a good question. That's definitely a question for otherwise. I mean, as far as I know, that's a pretty hard line. I mean, I think they have to. I don't think they can double internalize that. I think it's something like if they don't, then they go into delinquency, and then they might get. Then that sounds bad. Like I don't know, not just like slap on the wrist bad, but like they come in and then there's like a forced VWAP order or something like that. It might be under Reg Show. I don't know, or at least in the Reg Show package, even if a security doesn't go on Reg Show. But although there were 2.2 billion cat errors that Citadel committed last year, so I don't know if that matters. But still, I don't know if they can just choose not to do it, or there isn't any, as far as I know, there isn't anything that allows you to just like extend it another period. I don't know. Yeah. Why dilute? Why dilute before the live stream? Yeah, that's a good question. Volume was really high. Like Ryan Cohen was making his decisions on the basis of volume, and I think he saw an opportunity there. You know, hard to turn away $2 billion in cash. Like, hard to turn away $2 billion in cash, I suppose, for the company. In terms of, look, I would say it just like it was a big pivot from what might have happened. And this is the other thing too. Like, you know, he has a responsibility, I suppose. Like he's under scrutiny from like he's supposed to take actions to try to prevent short squeeze stuff from happening. Like seriously, if you go out and you sell like 45 million shares, like okay, that's a lot. But if you go out and you sell 110 million shares, you're like, we sold, or whatever it is, 140 million, 120 million, and then eventually 140 million. If you go out and you sell that many shares, and yet this stuff still goes off, you like the SEC or whoever cannot come to you and be like, you didn't dilute your company enough to prevent this from happening. It's like we diluted the company, whatever it is, 35%. And that wasn't enough to stop a short squeeze. We still don't know what happened to all those shares. We still don't know what happened to the, institutional filings only accounted, the institutional filings that came out in quarter two and for quarter three. Only came to a total of like 50 or 60 million shares, with less than half of the shares that were offered by the company. So I don't know, where'd those shares go? Where did they go? Contra's Chom. Cheers to you, CDL J27. Thanks for joining us. Very cool disco. Happy to hear it. Cool picture, man, by the way. Cheers, thanks. What do you think of all the dark pool orders today at close, aside from quad witching? Seems like a lot of shares transacted than usual. Interesting, Hian Huyn. I did not take a look because I was here doing this. Let's take a look. Where's my whale feed here? Let us go over here. Dark pool trades. Let's look at the dark pools. So dark. So dark. Okay. Oh, yeah. No, you're not wrong, dog. Oh, bro, what? Oh, what? Oh, that's massive volume. Are you kidding me? Can win. Yes, that is way, way more than usual. That is way more than usual. That is like 100x usual. That is 2 orders of magnitude. Look at this, but it's not even just like one order. Like we got, oh, so that's why we had that candle at the last second. Oh, man. Wow, they internalized all this shit. You know what? I gotta say, this is a weird amount of volume to all be processed like after hours or like a minute after close. I would not be surprised if all of this is like a giant lie, that this all wasn't like at market close. And this was all stuff that during the day, because look, like this was a weird amount of movement to get on no volume. Like it was so low today. That was what that was a weird thing. we ended the day with 19.5 million volume, but let's see if we can go down to an hourly candles. If we do hourly candles, what do we see? Not crazy low, but like not, let's move up by $2 in 3 hours kind of volume typically that you would expect. So it, like, I'll tell you, this looked to me like a VWAP order, right? Because the move starts right on VWAP. So the volume weighted average price. And then it's just a diagonal line. So this looks like somebody basically being like, oh, we got to settle something, and just and they just, force through a VWAP order. But that's a crazy amount of dark pool volume. So just even these shares, like to see a 58,000 order is a lot. To see even one order of like 150,000 shares is a lot. That's unusual to see an order like that. But we got immediately after close 165,000, 157,000, 138,000, 106,000, a couple little ones here, and then another one, 140,000, 141,000, 182,000, 384,000, 384,000, 329,000. And then this one, we got another one here of 138,000, and then this one, 1,127,551 shares. Who is buying those? That's what I would like to know. That is very interesting. Thank you for pointing that out, Yen Win. I did not have a chance to take a look prior to hopping over to the live stream. That's very interesting. Any guesses? Merry Christmas to you, Cosmo. RC looking out for the best interest of the company. Yeah. Announced earnings at the market before the live stream. I think as a lawyer told them they would be scrutinized too heavily for doing it after, potentially. Can they take out trades in the basket to cover the booth on GME, or is it locked in? I'm not sure what you mean by that, my friend Libertine. Would you please re-express that? How do you spot when it is a good time to buy leaps? Leaps are, I guess, designed to capture value over a long period of time. So leaps you would use if you like. You would treat it, I guess, like a share, right? You buy the share low when you think the price is nearing a low, and when you expect something like a big up movement to be able to capture. And you're primarily with leaps, you're primarily trying to capture intrinsic value. But you can usually do it at like, you can get a leaps contract, an at the money leaps contract for like half the money that you would spend on shares. So it gives you leverage it gives you like 2-to-1 leverage, probably something like that, maybe 3-to-1 sometimes, with a good hefty hunk of time, without, I guess, without, you don't have a margin loan. Indeed. Cheers, my friend. Yes. I don't know the answer to that. But also, this isn't quad witching. This is triple witching. Although it is apparently, somewhere I did see this. I think I got this through Spock Gamma's news. Was it Spock Gamma? No, I think it was like the Kobasi letter. Yeah, highest amount of notional options value across the market expired today. So 6.6 trillion in notional options value expired today at close. Highest in history. Tom, good question. The idea of doing a dark pool is never. That's the idea there. The only reason these would come and potentially hit the lit market is if they get internalized. They might not be internalized, right? Because you have to say, okay, what is a dark pool order? So when you have a lit market order, your order goes out and then your order flow gets paired, right? You get matched buyers and sellers. It might get divided up to multiple buyers and sellers, and then the order will be filled. Okay. Why send an order to the dark pool? Okay, well, first off, the excuse is, well, you don't want to send a really big order, could potentially disrupt. It could cause this short-term spike in the price, this huge disruption in the price that would, harm retail investors because they would think that some crazy event was happening. And no, right? Okay, we know just like anything, right? The real reason for this is not to fuck with the options market, because doing that might attract retail investors who would then pile in, think of it as like a squeeze opportunity, and then send a ton of options into the money, which they wouldn't want to have happen, cause a mini gamma squeeze, a bunch of, they have to hedge their positions, and then, right. That's the real reason why they do that, is my opinion for why they do dark pool stuff. You'll notice that they don't they don't stop shorts from doing that, right? Because GME is trending up, they don't reroute 100,000 or 200,000 or 500,000 shares sold short. But the day that I got banned, and this is one thing, the day that I got suspended from Reddit out of nowhere was the day that I posted what I thought was direct evidence of institutional shorting occurring on the lit market, and then organic order flow purposefully being rerouted to a dark pool such that it not counteract that at the ask. I wrote about that. Specifically, I put that in my post. That the day that I published that in review of the previous day's trading was the day that I got suspended on Reddit. So that's a particular element. Maybe I'm wrong, but that's a major reason why I think that happens. And you might say, why? Okay. So how does a dark pool enable that to occur? Don't they just have to, you pair a buyer and a seller off exchange? Okay, but still shares are transacted. So how does that affect supply and demand, right? Isn't there some other buyer that had, well, okay, maybe, right? Maybe you're pairing up two buyers, but maybe you're not, right? Maybe you don't maybe you're a market maker, or you're a broker dealer, and you don't want, or you have it, right? Here's another thing, right? Maybe you're not a market maker, right? Maybe you're a broker dealer and you have a special arrangement with the market maker where you guys will scratch each other's backs if you make sure that both of you stay optimally profitable. So the broker dealer may then reroute, I believe it's broker dealers who are in charge of order flow, of maintaining order flow. They are to a certain extent of it. So the broker dealer could then say, okay, we'll give whoever came in with this order, we'll push the share, we'll say that this person has shares in the account, but then we'll go over to the clearinghouse and we'll say, okay, we still need to purchase these, right? They'll do an FTD thing, and then they can say, okay, let me go to the market maker, let me interact with whoever is managing ETFs that contain this stock, right? They can do that there, right? They can use the dark pool as a way to set up these sort of fail to deliver boofing instances that otherwise talks about. The dark pool is a step where that can occur, because you don't get information about ask bid. You just get, oh, the order is there. The brokerages will put it on the tape, right? The volume will get fed into the lit market. And somehow, supposedly, an unknown, let's say you come in with a buy order, right? Let's say you come in with one of these buy orders for 160,000. Somehow, supposedly, you came in with a buy order for those shares. The shares get put in your account, but who's the seller? Nobody knows. And you weren't sent to any of these lit exchanges. You weren't paired up. Your order wasn't divided into all of these different orders. You were paired with your trade was instantly met by someone on the other side who took your bid and just said, I will buy exactly the amount of shares at your price that you want and will not do this on the lit exchange. Right? How is it for all of these that there was just a buyer there for that? Maybe there was. But interestingly, right, this can be fudged. The brokerage can give whoever this was the shares and then say, well, sometime within the next 35 days, right, we'll meet the settlement obligations or something with an ETF creation order. But then we'll come back, like we'll divide this up and spread this out over a number of trading days so that it doesn't have too profound an effect on the price. Something like that. So I would say that our pattern of buying today did look like, say, like an ETF rebalancing thing, something like that. But maybe those orders, I gotta say, it's weird that they all came in after hours. But maybe they came in earlier in the day, and they might not T plus 35 this. They might not kick it out like 35 days. Maybe they did some of it. I mean, I'll bet you this price action today was maybe some of that. But then, okay, maybe they just come back on Monday. Maybe they let this thing run on Monday when they would like it to run. Because if you let it run on a Monday, you can attract options buyers in who will buy. The price will run, but then you can walk it down by the end of the week and you can kill all those. The IV will go up and you can kill all those options contracts. You can send all those calls out of the money, which happens every week with GME. So maybe something like that, but I'll have to put some more thought to it this weekend and maybe remark on some of that definitely in my post on Monday. So thank you for pointing that out to me, Hyun Win. That's really something to take into account. That's right. We did. I remember that. Yeah, wasn't that on September 20th? Adopt. Yeah, for sure. For sure. Well, it's wild because the IV is so high. Okay, let me tell you that. The IV on GME is so high. If you look at other stuff, okay, I don't know. Let's even pick a correlated stock. Okay, let me hop over here. Right, here's a stock that's gotten a lot of attention recently. Okay, Chewy's IV, 56%. GME's IV, and today it really sold off. The IV really dumped, but by midday today, GME's IV was 125%, and that's after it dipped from where it was earlier this week, was 150%. So with these massive, massive IV swings, that's how you get stuff like this, right? That's how this happens. That's how midweek you have a 3 days to expiry options contract swing from being 25 cents to 10x to $2.70, and then end the week 0. Okay? In 4 days. That happens every week on GME. That does not happen every week on other stocks. Okay, there is no stock that has these types of IV levels sustained this high for this long permanently. Okay, if we zoom out, let's go over. We can go back to Sneezeville here, right? Let's do 5 years in a day. Right? Look at the IV here. Look at how high it stays. Look at how high it's been. Okay, let's pick, I don't know, what's like Tesla like? Okay, Tesla's high and it's got it at 77. If GME was at 77 right now, people would be dogpiling into long calls because of how low the IV would be. That's super close to our yearly lows. And that's pretty high right now for Tesla on this crazy peak. Whoa, what the heck happened there? Yeah. Or I bet you NVIDIA's got a relatively high. Oh, NVIDIA's at 50. These like, and now how about SPY, right? Okay, SPY's IV is 18.7%. It's almost 1/10 of GameStop. There is no, I tell you, there is no other stock that I'm aware of out there that just consistently has this type of implied volatility. I have to agree. I have to agree with these strategists that GME may indeed be the most important stock in the market for many reasons, but that's a major one. And the fact that IV is up that high, I think, says something that says that broker dealers also think that it is a very important stock. Yeah. Maybe I'm internalizing myself. Yeah, Tom remembers it. Yeah, I was super pissed, Tom. Tom's referring back to when I got suspended. Yeah. Yep, the day my account got deleted was when DFE tweeted and instantly an order hit the market. That was, I'm pretty sure, the exact value of the rerouted order you'd called out from the day before. Maybe. It was a lot. There were a lot of shares that were traded that day. I particularly remember. Could an option settlement arrive at the end of the day after hours? Yes, it could. But we don't typically, like when you say option settlement, do you mean like share obligations? Do you mean like delivery of shares won't happen? And typically they will prefer to kick any settlements if they have to like buy to cover things. They will kick that into the next week. Because technically options expiry is not until 11:59 p.m. Eastern time on Friday. So like right now, they're still like whoever has a vested interest in keeping, the 30s out of the money is still watching this closely, because like even if you look, they'll still probably be like a cent. Yeah, you see how the 30s still have value in them? That's because somebody could like go out here and try to like mess with the price and like knock it up and knock them in the money or something. You have to declare whether you want to exercise them by 5:30 p.m. I think 4:30 or 5:30 p.m. Eastern time. I think it's 4:30 Central, Chicago time. But the true options expiry is 11:59. Right here it is, right there. That's options expiry. That's why the red line on the chart is at 11:59, something like that. Is this the right time? Oh wait, but this is my time. That might be wrong. But true options expiry is 11:59. Whatever the value is at 11:59 p.m. That's how much value is in your contract. So this is why a lot of people do not hold to expiry, especially if it's if it's close to the money or at the money. Yeah. Hello in the woods. Thank you for joining us. Cool Shack. What was IV before the squeeze? That's a good question. It was up. I think it was like, right before it was like at 170%. It was still very high. Yeah. Here. It jacked up in April. See that? The COVID thing sent it to 427%. And then it was in the hundreds, basically. Yeah, it was in the hundreds. It was super high that whole year. It was in the hundreds. Lowest it got was like, actually, it did dip pretty low for a second there. Then it reversed and started climbing. And right before the sneeze, yep, it was like going, it was bottoming out at like 120%. And then it was going up to like 200 a couple times. And then, yeah, right before it went up. I think the highest it went up was like almost 700%, which is insane. Doesn't show it there, but shows a little lower here. But I think Spot Gamma reported it went up to like 700%. So 6 months before it blew. Yeah, no, right. So before the COVID thing, before COVID, it definitely wasn't. Right. Before COVID, it was like it did have some high periods, but it was, I guess before COVID it was kind of high, but it wasn't crazy high. It was still more normal. And then before, what is this? Like October 2019, just prior to October, I guess, what is this? Like September 2019, it went up quite high for some reason. But prior to that, no, it was super low. Nobody gave a shit about GameStop. 2017, it's like 35%. Normal IV levels. It's only been since, yeah, like August 2019 has it been high. And then in late 2019, it wasn't even that high. COVID dip, it got super high, and then it came back down. I mean, but everything did because of the COVID dip. It went back to normal levels, but then it just climbed the whole time. So, okay. So I think we will bring our live stream for this week to a close. Thank you very much for all your questions. As always, you guys are always welcome to send me questions anytime if you have any. I'm certainly happy to help. Thanks very much to Otherwise for his hard work and for coming on the show, right, and for agreeing to allow his work to be featured today. Thank you very much. Made a great topic of discussion. I hope this was informative for you guys. I hope I was able to bring together some useful information in terms of being able to think about what the squeeze really was, what maybe some of this May-June stuff was about, what we might have going forward, and as well to think maybe about some potentially productive ways that you might educate or entertain yourself with respect to trading, something like that. So looking forward to seeing you guys certainly next week. I'll have the videos up next week. We'll have daily articles as well, and we'll have to I'll have to see what happens maybe with some of those dark pool orders, what that might mean for us next week. Maybe some insiders reveal they did something. Who knows? So cheers everybody. Cheers Tom. Cheers Noodles. So have a great weekend. Dork Court. Little Serotonin. Oh, great name. Great name. Cheers. Cheers everybody. We'll see you next week. Take care now.